Donald Trump's economic policies present a paradoxical approach to global trade and finance, aiming to bolster US dominance while undermining the very systems that sustain it. By leveraging tariffs, sanctions, and financial warfare, Trump seeks to reshape international trade dynamics, but these strategies risk triggering global economic instability and long-term harm to American competitiveness. Trump's dual goals of reducing the US trade deficit and maintaining the dollar's global reserve currency status are fundamentally at odds. The dollar's role as the primary reserve currency requires the US to run trade deficits, supplying dollars to other nations for trade and debt repayment. However, Trump's tariffs, such as proposed 100% levies on BRICS countries pursuing de-dollarization, restrict dollar liquidity, making it harder for nations to service dollar-denominated debts. This contradiction risks destabilizing global financial systems, as seen in historical parallels like post-World War I Germany, where currency depreciation and debt defaults spiraled into economic collapse. Most global South nations hold dollar-denominated debt, forcing them to exchange weakening local currencies for increasingly expensive dollars. Federal Reserve rate hikes exacerbate this by strengthening the dollar, raising debt burdens and inflation in these regions. Mexico exemplifies this vulnerability. Remittances, 5 to 6% of GDP, and exports to the US underpin its economy. Tariffs or export restrictions could force austerity measures or debt defaults, inviting US retaliation like asset seizures, a tactic previously used against Argentina. Trump frames international trade as a competition where only the United States should win, rejecting mutually beneficial agreements. His strategy relies on financial coercion, sanctions, tariffs, and disrupting global supply chains to pressure nations into compliance. For example, European NATO members are pushed to increase defense spending to 5% of GDP, funneling purchases toward US arms. Threats of 25% tariffs on European exports aim to weaken the euro, enabling US investors to acquire distressed industrial assets at bargain prices. This approach harms US competitiveness. Restricting exports to China stifles profits for American firms like Intel, limiting R&D investment and weakening technological leadership. While Trump advocates reindustrialization, his policies inadvertently strengthen the dollar, making US exports uncompetitive. Wall Street's influence, exemplified by Treasury Secretary Scott Bessent, a hedge fund billionaire, prioritizes a strong dollar to boost financial asset values, undermining manufacturing revival. Even a 90% dollar devaluation would take over a decade to rebuild supply chains, given the US's reliance on finance over production. Trump's aggressive tactics assume nations will acquiesce, but coordinated defiance could upend the dollar-centric system. Latin American, African, and Asian nations might collectively reject odious debts, mirroring China's win-win infrastructure investments that foster regional trade networks. Such a shift would challenge US dominance, prompting harsh responses like asset freezes or sanctions. However, sustained global defiance could erode the dollar's hegemony, a risk Trump's policies inadvertently accelerate. Trump's economic strategy is riddled with contradictions, championing a strong dollar while seeking reindustrialization, demanding trade deficits for dollar dominance while imposing tariffs to shrink them. These policies risk inflation, job losses, and global financial crises while empowering Wall Street over Main Street. As nations explore alternatives to dollar dependency, the US faces a reckoning. Its coercive tools may soon spur a fragmented global economy, diminishing its own influence in the process. Please subscribe to our channel for more insightful content on global trade and economics.